Robinhood stock is absolutely skyrocketing here on some of the new crypto offerings that they've just brought to market. They're also trading at record highs here just recently. They were jumping up massively the other day and have continued to follow through. And what we see here is that they're launching more US stock and ETF tokens and perpetual futures in Europe. And US customers can take part in crypto stalking. I mean, just take a look at the stock price here. You can see Robinhood trading up to $92 a share. And this is absolutely crazy considering we were just at the 30 range. This is probably one of the most crazy moves I've seen in a stock in a long time, up 200% since the lows that we saw in April. Now, Robinhood is a stock that I own in my portfolio, and I want to talk a little bit about the predicament that I'm in with these shares. Now, I've been very correct in buying Hood shares, right? Robinhood has jumped dramatically, and I've been on the right side of this move. That is, until we take into consideration the fact that I've also sold calls against my position. And the frustrating thing about selling calls is that it creates a way, the good side is that, selling calls creates a way for you to generate income on shares that you that own. And I actually thought that Robinhood was starting to get overextended. It just goes to show you when a stock is really running, how it can just essentially go in one direction for a very long time. That being said, I've sold calls on my Robinhood position at the $85 strike price. And so now with the share price trading at $92, I've essentially given up my right to the shares beyond this $85 strike price between now until expiration date for my calls, which is the 11th of July. And while I do think that Robinhood itself is overextended, I would prefer, if I can, to take a loss on the calls that I've got here and actually look to roll the calls further out in expiration date and higher up in strike price. I do think that Robinhood is a $100 stock, and I think that it can continue to be a major player in the future of finance. One of the big reasons I love this stock is that millennials and Gen Z traders and investors absolutely love the simplicity of the platform. And I think that in many ways, Robinhood brought many traders and investors, especially new ones, to the markets with their commission-free trading platform that they launched years ago. Their user base has also grown steadily, and with the rise in crypto, many traders and investors love using the crypto platform that they're offering. So the new exciting news with new products being launched just goes to add fuel to the flame to what is already a very hot stock. So what am I doing with my own position? Well, I do have a really big winner here with this stock. I'm up 130%, but of course I've given back some of those gains with the calls that I am short through the covered call position that I have. So my game plan personally is to look to do one of two things. If we get share price on Hood to come down a little bit, I'm probably going to buy back these calls for a loss. But I'm unwilling to take the full loss of $4,400. What I'd like to do is to, basically, if I can get an opportunity, if price comes down between now and expiration date, to just close out for either a break even or a controlled loss and keep the shares. If I don't close out, what is likely to happen, if the stock price is at current levels or higher, I will get called away from my 600 shares of Robinhood for a profit of whatever the profit between my entry and the $85 strike price is. So I currently have, like I said, a good sized position on this stock, and I do think it's overextended, but I think that the long-term potential for this company is very strong. So while this was a trade for me, it's a stock that I really want to own for the long term as well. So if we get called away, what am I going to do? Well, if I get called away and I take profits on the stock, I'm going to close out everything here. If that happens, right, then I'm just simply going to wait for an opportunity for the stock to drop once more. And if and when it does, I can then look to potentially rejoin the trade or rejoin the stock. In other news, we've seen the Senate passes Trump's agenda bill after a marathon voting session. This means that the big beautiful bill is headed to the House, and another high stakes battle now looms as the bill must pass in the House before heading to the president's desk. And we saw an interesting response to this. Small cap companies jumped here over the news of the Senate passing this, and I do have a good sized position on IWM. I've actually trailed my stop loss here recently, and I want to talk a little bit about why I think small cap stocks could actually do quite well, and also some other areas of the stock market that I think could do well in an environment in which we do see rate cuts. IWM is probably the most easy one for me to break down because let's talk about what is in the IWM. So the Russell 2000 Index, or the IWM ETF, is comprised of many different small US companies. Now these are still big companies relative to, small mom and pop shops, but they're much smaller than companies like Apple and Amazon, Google, etc. So this collection of small companies is something that I think is very poised to move higher this year due to the idea that I think rate cuts are coming. I'll talk about the macro in just a second, but what's inside of the Russell 2000? Well, it's a collection that is a little bit heavier on the healthcare stocks, industrial stocks, and financials. An ETF like IWM carries a whole basket of different types of companies and stocks, but it is heavily comprised of these three types of companies or sectors of companies: healthcare, industrials, and financials. And they are also, like I said, small companies which are actively growing and do require borrowing in order to grow, right? These companies are investing for the future. That's why they're publicly traded. They're looking to raise capital, and they oftentimes have to take debt or borrow money. And so the rate at which they borrow money, a sensitive topic for smaller companies. And so if the Fed cuts interest rates, I think that it will give small caps a new tailwind that could really allow them to do a bit of catch up in the financial market, where we've seen for the most part in recent years, things like the S&P 500 dramatically outperform the IWM. Take a look at what I've just done. I've compared the S&P 500 versus the IWM, and you can see that the clear outperformance in recent years is quite obvious. So what we see here is that big cap companies have outperformed small cap companies, and I would largely credit a lot of this to the idea that bigger companies are not so sensitive to borrowing money and the rates that they have to borrow them at. Another area of the market that I think will do really well in an environment in which the Fed is cutting interest rates is technology stocks. Technology stocks and this is the XLK ETF, technology stocks are an area of the market that is definitely sensitive to interest rates because technology requires a lot of investment for the future in order to build the latest, greatest things. And so the rate that you borrow money is very important. Another area of the market that seems very interesting and also breaking out currently is the financial sector. Take a look at the financial sector breaking to a fresh all-time high here. The XLF ETF tracks a big basket of banks and all sorts of financial service companies. And what we can see is this thing is breaking out to a fresh high here at the time of recording this video. And I do think that financials can continue to do well, especially under this kind of recent regime with the Trump administration. We see financials moving higher, perhaps in anticipation that more mergers and acquisitions can occur, less federal regulation in the business or corporate world, and lower taxes, and also lower interest rates, which all kind of play into what I think is a good environment for financial stocks to do quite well. One of my favorite financial services companies is PayPal. Let's take a look at this one. PayPal is the type of stock that I don't mind having in my portfolio. Of course, not in a huge amount, as I don't like to put all my eggs in one basket. But when it comes to PayPal, it's a stock that I feel good holding in the portfolio. It has rising revenues, rising net incomes, and their profit margins are pretty steady. Additionally, the PE ratio for this stock, PayPal, ticker symbol PYPL, has gradually actually come down, which is a healthy sign in my view that perhaps what was sort of a more speculative stock in the past has become a much more moderate sort of normalizing stock. If you zoom out on the weekly chart for PayPal, look what happened to this thing. This thing was a $300 stock and is now a $75 stock. Does that mean this stock is worthless now? No, but a lot of the criticisms towards PayPal were, number one, its valuation was insane back here, but also the idea that, Apple Pay and all these other payment processors were going to come and steal all the market share from PayPal. But I still see in this stock a company in which we are still seeing rising revenues, rising income, and I use it for my personal business all the time, and it's a remarkable service. It's clean, it's easy, and for many people, they've used it for maybe even decades, and it's a very simple, intuitive platform that I think has a lot of sort of built-in legacy. Just like when I think of, making payments to people, I think of Venmo, which is also offered by PayPal or owned by PayPal. These sorts of payment processing services, I think, are ingrained in our society, and I think that PayPal can continue to be a profitable and growing entity for years and years to come. Take a look at the earnings per share for this stock, rising over time, and also a 4 in a row beat on earnings per share compared to analyst expectations for PayPal. This is a stock that I like quite a bit, and if we do get dips, I'll be looking to add more shares. shares. I would love to get my PayPal position up to 500 plus shares and possibly even up to 1,000 someday. By the way, if you want to check out the stock box, it's a tool that my team and I have built here behind the scenes. There will be a link in the description down below to where you can get some information about the stock box. And if you click the first link in the description and send us a message today letting us know that you watched this video, and we'll give you an extra 5% off just for sending in a direct message and letting us know. So with all this crazy movement in the market here recently, we've seen a lot of stocks really running hot, especially some of the big ones like Google. Well, Google's done okay, but more specifically things like Meta and Uber and what we were just looking at with NVIDIA, right? We've seen these huge moves higher for a lot of stocks. And the way I look at this is, I do want to be cautious that I'm not, sort of just holding on greedily thinking that these things are going to go up forever. But when it comes to companies like NVIDIA or Meta, it's hard for me to see an environment in which case right now, these stocks don't continue to do well. These companies are growing really quickly. The AI stuff is really, really strong for these companies. And NVIDIA has a backlog of orders for chips, more so than they can even produce. To me, that is an environment where I want to continue holding NVIDIA. As a shareholder, I bought during the April sell-off, February, March, and April, I bought some more shares, and I now have 500 shares of NVIDIA, which I'm super thrilled about, and I'm sitting on a really nice gain in the stock, even though it got really ugly before it got really nice. When it comes to NVIDIA, I'm not personally looking to add more shares to NVIDIA at this time, but still, I really like the shares, and I want to continue holding. Similar thing in Uber, I'm actually feeling a little bit of regret because I wanted to add some more shares to Uber, but I just didn't have very much available margin in the portfolio at the time that it was pulling back. But this stock has absolutely popped here recently with the announcement of Google and Waymo's crossover. Uber has also had some really impressive revenue growth, net income, price to earnings looks a lot better than it used to, and the earnings per share here has beaten in the last 4 quarters in a row, something that I like to see in stocks that I own, and earnings per share has gone from negative to now grinding higher. If you enjoyed my video today, make sure to hit the thumbs up button and let me know what stock you want me to cover next. Thanks very much for watching and have a great day ahead.